Okay. I'm Austin Goolsby of the Council of Economic Advisors and the Chief Economist of the Economic Recovery Advisory Board. Welcome everyone who is watching to the next of our series of public meetings with experts about tax reform in preparation for the PERAB's report on tax reform. Why don't you guys just introduce yourselves and then let's just get started.
I'm Barry Melanson, President and CEO of the American Institute of CPAs.
And I'm Ed Carl, Director of the AICPA Tax Division in Washington.
Thank you for having us here. It's a real pleasure. As I said, I'm with the AICPA, and I think it's important just to give you the frame of reference of what our comments and remarks and materials are all about. We have 360,000 members who those in public practice work in 44,000 CPA firms, so they touch essentially every taxpayer and certainly every business in the United States. And the materials that we've provided and those that I will give some highlights to today are really the output of our tax section, which has 25,000 people who specialize in tax and who work through a series of committees with over 200 volunteers. So there's been a lot of thought into what we have here. Some publications that we've had in the handouts, et cetera, that will support that. And we think we have a long-standing record of providing public interest-oriented, unbiased information. You won't find a lot of my remarks saying specifically this is what a tax rate ought to be or whatever. Ours is more from a policy perspective and looking at it from that standpoint. So we're pretty proud of the work we've done with various groups in Congress, the White House over the years, as well as the IRS. Today I'm going to cover a suggested framework for evaluating tax reform proposals, our thoughts on tax simplification, which we know is a major initiative or focal point for the subcommittee, our recently updated publication on tax reform, which we think will be a very valuable resource for you, some ideas on alternative minimum tax, some ideas on the estate and gift tax system, and reference a compendium of technical legislative proposals and some other things that we think can simplify the tax system, like civil tax penalties, et cetera. Clearly, every year discussions take place among policymakers, politicians, economists, and obviously preparers on how to reform tax systems. Some proposed changes would make fundamental changes, for example, replacing the federal income tax with a consumption tax. Other proposals alter the existing system by adding or expanding tax incentives to encourage savings, modernizing the international tax rules to better address today's global economy, or making even procedural changes. Every suggestion to modify taxes, whether they're major or minor, raises, we believe, a common series of questions on how to best analyze and compare the proposals. As part of its efforts to promote this sound tax policy, which we really think this is what this is about, we have published 4 tax policy concept statements, which discuss various principles of good tax policy. We furnished you in electronic format and as well as in the handouts today all of these tax policy statements, and I urge you to take a look at them and take them into account as sort of a starting point, a philosophical point, as you will measure various things that you will debate and ultimately make various recommendations to. So as an example, our tax policy statement on number 1, it's entitled Guiding Principles to Good Tax Policy, a Framework for Evaluating Tax Proposals, and it is in your materials. And it lays out this framework that we recommend using as a guideline. There are 10 guiding principles that we think you can look at and evaluate any proposal that you are considering as you go about making various decisions. And just to summarize those for you, and I won't do this with each of these in the interest of time, but we think this is the starting point. So for instance, we focus on equity and fairness as a consideration. Certainty, tax rules having some certainty to the taxpayers is very important. Convenience of payment, no tax system, regardless of its objectives, unless there is a reasonable way of collecting the taxes, really works. Economy and collection, which ties into that particular point. Simplicity, we are major advocates of simplicity. Neutrality, meaning the tax effect on one taxpayer in a similar situation is reasonably the same. Obviously, economic growth and efficiency. Transparency and visibility. There are many things in the tax law, and I'll reference some of them, that are highly confusing. They're intended to incent certain things in the tax law, but taxpayers cannot really comprehend them, and as a result, they don't have the desired effect. Minimizing the tax gap. We think there are some things from a simplicity and efficiency standpoint that will help raise the percentage of the sort of theoretical amount of tax to be collected. And obviously, one of the considerations is appropriate government revenues. Let me focus first on simplicity. We know this is a major focus of the subcommittee, and we have been a long advocate of simplification and fairness in the tax law. I'm often, as the person who represents 360,000 CPAs, I'm often, when I say that, people say, yeah, right, CPAs really don't want tax simplification, and that's simply not true. Really dating back into the early 80s, we've had major campaigns consistently on tax simplification. There are some 3.7 million words to that effect in the tax code, and not counting regulations and everything else. And we believe it can be much more efficient from that standpoint, and as CPAs, we think we can bring a lot to that particular point. We particularly see a lot of problems for small businesses and the sort of the personal side of small business, the entrepreneur whose small business flows to them in some form or fashion. A growing number of taxpayers perceive the tax law to be unfair. That's what our members tell us. I think it greatly impedes the continuing efforts of the service to administer and enforce the law. The cost of compliance in small businesses is increasing every day, and obviously affecting business decisions from that standpoint. And we would say the complexity actually interferes with economic decision making for small businesses. And from an economic stability standpoint, we would think that that's not the best possible result. The end result is the erosion of a voluntary compliance. By and large, business people want to obey the law, but it's only human nature to inadvertently disobey the law if you don't really understand the law or its context, and as I mentioned, the size of the system, and in many ways an outdated income tax system. There are various types of simplification. We've identified three. There's simplification that reduces calculation complexity. There's simplification that reduces the filing burdens. And there's simplification that reduces the chances of a dispute between the IRS and the taxpayer. And quite frankly, the first two types of simplification are sometimes the easiest to identify and fix. Clearly, the third group revolves around hard choices, hard policy decisions. And, you know, we all know computers help and forms help, but it's not just about math. In fact, it's far from math. And this type of problem, you know, adding certainty to the tax law and reducing the likelihood of disputes is the most difficult to effect, but maybe the most important. Clarifying tax law is hard to understand, but it must be a priority. With that in mind, I'll reference another document, which is our policy statement number 2, which is the guiding principles to tax simplification, which is set forth, as I said, in there. And I'm not going to go through all of these, but there are things like seeking the simplest and most transparent approach to getting a desired policy objective. A good example on that is, for instance, there are some 14 or so different education type of incentives as a policy basis in the system. Well, the fact of the matter is that because they're so complex, people really don't understand them, or not many people do, and as a result, they don't get the desired effect of incenting people in that particular area. So we would be advocates more of a system that says the public policy issue says we need to do some things in the tax law to address education. We ought to have one bucket for that. If it's not getting the desired effect, you step it up from a dollar's perspective over time, but having multiple answers to the same policy do not necessarily create the types of responses that you want from the consuming public or the tax-paying public. Another example is minimizing compliance cost. Another, for simplicity, reducing the frequency of changes in the tax law. I can tell you there are something greater than 6 million small businesses in the United States, and virtually every one of them has a CPA relationship. And finding a way to have less frequent changes is a very key element to good business decision and investment decision by those businesses. The constancy of change, some of it is unavoidable, but the constancy of change creates some issues from that standpoint. using consistent concepts and definitions. Until 2004, we had huge numbers, for instance, of definitions of what a child was for tax purposes. Now, there were some steps to try to rationalize that, but we still have at least 3 different definitions in the tax code of what a child is, which obviously, just on its surface, is a form of complexity from that standpoint. Obviously, simplicity revolves around the ability of the IRS to administer the system and enforce the laws rationally. And another area of simplicity to be considered is laws that apply to just a limited set of taxpayers or for a short period of time. Phase-ins and phase-outs are very complicated from a planning perspective and I think affect decision-making probably inadvertently. We're also committed to helping our tax system not only simple but as fair as possible. And as mentioned before, we believe that, that we can do a lot of things from that standpoint. We've issued a document. We do these periodically, and this has again been provided to you. It's a very long document. It's called Tax Reform Alternatives for the 21st Century. We think that you will find it very useful. There are things in here that are not really the focal point of your charge. For instance, it looks heavily at alternative tax systems, and it looks at sort of the issues of transition for those alternative tax systems, which are very complex in and of themselves. But in Chapter 4 of this document, it also looks at improvements to the current system. And so we would call your attention to that particular report. We can make as many of those available to you as you'd like. And it is, like I said, an update of actually a document that we have produced periodically. Here's a version of it from 2005. We continually update it for the environment, the economic situation, et cetera, that goes on. And we think it's a useful document. It's been used by policy decision makers in the past. We do understand that in making your recommendations, ultimately, there are some facts that you have to consider, and we're very sensitive to that in this publication, like dealing with the economic strain of the baby boom generation, understanding the impact, the human impact of expiring tax cuts. You know, as an example in this area, there are certainly advocates of just allowing the tax cuts to expire. That may be fine from a revenue-generating perspective, but that assumes that the taxes and the approach that was there when the tax cuts were implemented is the right policy decision today. It may well be that you have to look at it from a different policy perspective. And then finally, we think controlling the exponential growth of the alternative minimum tax has to be addressed. 20,000 taxpayers were impacted in 1970 with the AMT. Without any change, it will be 30 million in 2010. Most of them not the target of that area. And I'll comment more on the AMT in a moment. In addition to debate over the appropriate levels of federal deficits and national debt and the appropriate levels, therefore, of federal revenue, we know is far from settled and is a key component of recommendations that have to be made. We understand that. And all of these things are part of the impetus to consider tax reform. Current economic conditions as well as future revenue needs will affect the debate. And while others may present challenges that's deemed to be too great to overcome or unacceptable, we think they can be overcome. The report discusses 3 general approaches to tax reform that have emerged over time. Improving the current system through revisions without changing the fundamental character of the system. Replacing the current system or major parts of it, such as consumption taxes and the transition issues associated with it, as I referenced. And revising the current system, but also adding other elements like a consumption tax or things of that nature. And I'll focus on Chapter 4, as I mentioned, which is the major charge, I guess, of this subcommittee. So a couple of examples. I mentioned eliminating the alternative minimum tax. Consolidating education and retiring savings incentives. Can still obtain the desired policy effects, but make it simpler. Replacing a very old 20-factor worker classification test into really identifying who's an employee and who's a subcontractor. And even simplifying the earned income tax credit. The fact of the matter is that it's one of the areas of the tax law that has the greatest number of errors. We fully recognize it has been one of the most successful programs that the government has brought forth in sort of an anti-poverty policy perspective, but that doesn't mean that the income tax credit couldn't be made more effective from that standpoint, earned income tax credit. We also focus in this Chapter 4 about how to avoid the use of phase-outs, temporary provisions, last-minute provisions in writing the tax law, and also how to close the tax gap through a more efficient tax system. We don't take a position on a best possible solution to reforming. We do encourage an in-depth debate on the issues undertaken through an organized and logical process with the goal of enacting good tax policy reforms in the near future. We understand that some of these issues are truly policy issues. And by looking at how the tax law fits into those policy decisions and making good decisions, we think that's how you will get to the most efficient tax system. The unifying goal should be established now as the effort before you get to the details, because that will allow for the most rational decision making. This should be your first step. And the 10 guiding principles that I referenced earlier really are the basis for that. I've mentioned several legislative proposals, and let me get into a little bit more detail and some specific recommendations that would address those, including the alternative minimum tax and the estate and gift tax system. We recognize that eliminating individual AMT, although preferable by many policy members and certainly many taxpayers, may not be feasible because of the large revenue loss that is likely to result. As a result, we have proposed 13 alternative solutions, each one of which would reduce some of the complexity and the unfair impact of AMT as currently imposed. The full text has been provided to you as another handout, but let me give you a couple highlights. For instance, we would say that one way to simplify AMT is to ensure that all taxpayers with adjusted gross income under $100,000 are exempt from AMT. It wasn't the intent of AMT at that level of income, and it would simplify tax matters for many unsuspecting individuals by making that cut at that particular level. We think increase and index for inflation the AMT brackets and exemptions so that we don't have an unfair ratcheting up over time, and eliminating phase-outs would simplify it. We would also propose that to allow for AMT purposes a series of deductions and calculations so that they would be the same for regular income tax purposes as AMT purposes. This would simplify and produce fairer outcomes from that standpoint. For instance, standard deductions, dependency exemptions, miscellaneous itemized deductions, so individuals at those income levels could enjoy the deductions for employee business expenses, medical expenses, and even the deduction for state and local income taxes. And maybe most importantly, and that's probably unfair to say most importantly, but we also think that we should exclude the AMT from the estimated tax penalty. Many people get AMT taxes, have no idea even what AMT is. They're caught by that. And not only are they caught by that tax, but they're inadvertently caught by underpayment of taxes, and it feels to many of those taxpayers as sort of a double whammy in that particular environment. It seems a little unfair. On estate and tax reform, gift tax reform. We've also provided a publication on this. We have been active in this really since this debate has begun, dating back in earnest in 2001, where we issued a study. These reforms that we proposed back then are still applicable today. The study focuses on the complexity of the current system, taxpayer planning and compliance burdens, ease of administration, and revenue constraints. The AICPA study remains very relevant today and timely, as I mentioned. And it also focuses on the totality of it, not just estate, but gift taxes and other transfer taxes that exist in the system. We've issued a January 2009 letter on the study, and we have provided these suggestions, many more than these, but let me highlight 4. Increasing the exemption and indexing it for inflation. We know that 2010, because of the existing law, is a particularly difficult year. We believe that you put in a system, we put a reasonable, whatever the policy decision is on what the exemption should be, we index it for inflation and keep some stability in that transfer system from that standpoint. We believe that, contrary to what will happen in 2010, that we should have, through the estate tax system, a full step up in basis for inherited assets, and avoid what will be an incredibly complex system of carryover basis that will go into place with 2010. It's essentially it would pretty much dwarf a lot of the complexity that we already have in the system if that were to remain in place. We think in the estate tax you should recommend things to provide broad-based liquidity relief rather than targeted relief provisions. It's one thing to have a tax levy, but we should not be forcing, and we know there are some targeted relief provisions for family farms and other things, but we should have broader-based liquidity relief so that people pay the appropriate taxes that the policy warrants, but at the same time not forcing family assets in some form or fashion to be disposed of inappropriately. And also, we believe that the portability of whatever exemptions are in place should accrue to surviving spouses to simplify estate planning and estate administration for married couples. We should not force married couples to go through a series of legal maneuvers in order to maximize these provisions. You can do them through the legal maneuvers. Why don't we just recognize them in the tax law and simplify from that particular standpoint? I won't go into these in detail. We've also provided a compendium of legislative proposals beyond the ones that I have just covered that we believe can be addressed, that would meet the goal of promoting simplicity and fairness in the Internal Revenue Code. We've released this in July of 2009, and we've provided this to you. I would say these do not rise to the high-profile nature, maybe even the political debate nature, but they are that AMT or estate taxes might, but they are very important to meeting that objective of simplicity, and we would commend to you to take a look at those. We think that a lot of them can be done efficiently and effectively and take a step in the right direction from a simplicity standpoint. Likewise, civil tax penalties is another area that comes into that particular environment. We do have concern about civil tax penalties. We have a sort of a system that civil tax penalties have been built over time. They're layered. They're very complex. We acknowledge you need civil tax penalties to incent compliance with a voluntary compliance system. However, the way some of these are applied, the way they interact, in some cases, for instance, there are civil tax penalties that even when there's an error, the IRS may levy the penalty, and they don't even have the ability to withdraw the penalty based on the way the law is written. So overbroad, vaguely defined, and disproportionate penalties, they actually disincent the objective of creating high levels of compliance with a voluntary system. People at some point throw up their hands. They just get frustrated from that standpoint. We think while this would never be something that would be high profile, this would in fact over time create greater compliance, minimize the tax gap, and would cause taxpayers to view the tax system a little bit fairer from that particular standpoint.
I know you guys face a hard
that was my
stop
last
to
comment.
Oh, that was your last, okay.
I was just going to say thank you for the time. We've provided you a lot.
Thank you for these materials.
A lot of information.
We have said that everybody that presents, we are going to make the materials available publicly.
We're fully aware of that. No problem with that.
And we really appreciate all the efforts that you have done to make us clear those ideas and for clearing out some time on your schedule to talk with us.
Well, that material that's in there was emailed yesterday, so you have it all available electronically.
And I think if you see the policy statements and the detailed recommendations, it obviously, not to unload, but we're happy to work with you on any of those to clarify.
Okay.
And to help you make some decisions that or input that might be valuable from that standpoint.
That's outstanding. Thank you very much.
Thank you, Roger.
Okay, thanks for the opportunity to testify and for the important work of the panel. I'm Bob Greenstein from the Center on Budget and Policy Priorities. And
Chuck Marr from the Center as well.
We have more material in the handout than we have time to go through, so we're going to go through parts of it and breeze over other parts of it. We start with major goals of tax reform. Most of these need no time: broaden the base, simplify. I think the 2 points we wanted to make here are that while it seems the tax reform should follow the spirit of 1986, broaden the base, lower the rates to the degree one can. We think that the serious long-term fiscal problems the nation faces means that, unlike in '86, this time the goal should be not only to simplify and broaden the base, but in the process of doing that, to end up with some net revenue raising to help with long-term deficit reduction. We obviously think changes are needed on the spending side of the budget as well. And needless to say that the revenue raising should be done in a way that's economically efficient. The other thing worth noting is, just as the federal government faces serious long-term fiscal pressures, so do state governments, and so we think care should be taken to assess the impact of reform options on states and make sure reform options do not make state fiscal problems worse. I'm going to skip over the slides on the long-term fiscal problem. You all know about that. Briefly, but very briefly, note the slide that presents the CBO data on changes in the income from 1979 through 2006. It tells the familiar story that due primarily to changes in the economy that are external to government policy, there's really been a significant widening in inequality. And simply our point here is this is, should be a piece of context, and that tax reform, to the degree possible, should seek to lean against this trend, not to exacerbate it. The next slide just makes the same point that I made a minute ago about state revenue issues. As I presume you know, most states with an income tax tie their definition of taxable income to the federal definition, so changes in the federal. Actually, if one broadens the federal base, it helps state fiscal conditions, so one gets another benefit there. Now, we did want to focus a little more on a few issues. One of them is tax expenditures. As you know, they're very large. I was in '94 a commissioner on the Kerry Danforth Entitlement and Tax Reform Commission, and I still recall Alan Greenspan's testimony when he specifically used the word tax entitlements to refer to these. Many of them are effectively government subsidy programs that do not get the same degree of oversight and transparency that explicit subsidy programs get. There are a variety of estimates of how much tax expenditures cost, but regardless of what estimate one uses, it's a very large number. In the slide number 9, we make the point that we would hope maybe the panel could think about some options to increase the transparency of tax expenditures. We think it would be useful if OMB and CBO in their periodic budget analyses elevated a little bit how large tax expenditures are in cost. One option that the budget experts at the center have sort of suggested is that one might actually want to have some budgetary displays in which tax expenditure costs are classified as outlays for presentation purposes. The larger theme is simply to elevate the degree of attention that's given to them. Moving to the next topic, although it's obviously a related one of the major forms of tax expenditures comes through itemized deductions. They're designed to create incentives for socially beneficial behavior, but their value is tied to marginal rates. And we refer particularly here to the important paper by Lily Batchelor, Fred Goldberg, and Peter Orzag of a few years ago that found the subsidy structure to be economically inefficient. The next slide, we just have a couple of pithy quotes from the Batchelor study, but they really say it as well as one can, that providing a larger incentive to higher income households, as deductions do because of the rate structure, is economically inefficient unless there's specific knowledge that higher income households are more responsive to the incentive or they're engaging in the behavior generates larger social benefits. In thinking of reform proposals in this area, the president in this year's budget proposed capping itemized deductions at 28%. That proposal does not appear to be gaining traction in Congress. But what we would suggest as an initial step that might be politically viable would be to cap them at least at the top rate, current top rate of 35%. Given their economic inefficiency and the revenue problems we face, there really is no good rationale for having them go back up to 39.6% when the top rate goes back to 39.6.
Yeah. And here, your work could be very timely because next year they have to decide that. So this is, you know, as an incremental. So if you sort of agree with us and with Peter on the sort of direction you want to go, this sort of for the Congress is the first point where they really have to decide, and you could give it a little momentum if you so chose to come out and recommend that, because they have the rates are going to go on a track to rise, and the Congress would have to by the end of next year step in and say no, we should keep the value deductions at 35, and that's sort of a first step, and you keep things sort of a status quo, which would be a step forward, small one.
And on policy grounds, a desirable broader reform, we do not underestimate the degree of political difficulty of it, is the reform that the Batchelder-Goldberg-Orszag paper recommended of converting deductions that don't have positive behavioral incentives, converting them into uniform refundable credits at a 15% subsidy rate, which is in essence the direction that the 2005 Bush tax reform panel took with regard to mortgage interest. There's perhaps no area in which the current deduction and tax expenditure structure is more inefficient, or to use a word in his prior life I heard Peter Orszag use several times, more upside down than retirement tax incentives, where there's $120 billion in foregone revenue to subsidize retirement saving, but the bulk of it goes to the top of the income scale, where the evidence is that we largely induce shifts from taxable to tax-preferred retirement accounts rather than generate additional contributions. I think the figure is that more than 70% of the tax benefits from preferences for retirement plans go to the top 20% of households. As a first step, there are some very solid incremental reforms in President Obama's 2010 budget. We note them on slide 15, expanding the Savers Credit and making it fully refundable, and establishing a system of automatic workplace pensions. Again, the broader reform that we would think is the more desirable as an ultimate goal is the sort of thing proposed, in this case in a paper by Bill Gale, John Gruber, and Peter Orszag, where they proposed establishing automatic accounts and replacing existing tax deductions and exclusions for retirement contributions on a revenue-neutral basis with a uniform 30% federal match that would be deposited directly into a savings account. Moving to the corporate area, won't spend much time here. We have these slides in simply because one hears too often the emphasis on the relatively high, compared to other Western countries, marginal tax rate in the corporate income tax, but reference isn't always made at the same time to how narrow the base is for the U.S. corporate tax. So the next several slides take various kinds of investment and show how narrow the base is, and it leads one to slide 20, where we find the seeming anomaly that despite having a relatively high marginal corporate tax rate, the U.S. actually collects less in corporate income tax as a share of GDP than the majority of other countries, OECD countries. So the conclusion, obviously this leads to hardly an original one with us, is that the corporate area badly needs reform with a broader base and a lower marginal rate. And we also think this is one area where one could do a broader base and a lower marginal rate and try and do it in a way that there is some net revenue increase for deficit reduction purposes. Again, on slide 21, we note the conclusion that the Bush Treasury Department reached in a report it brought out on in 2007 about the contrast between the high marginal rate and the low average corporate rate.
Right. And just one sort of seemingly small point, but I think in terms of process could actually be very helpful and constructive for the panel to consider recommending, deals with tax extenders, right? And you're obviously going to propose corporate tax reform proposals, sort of broaden the base. Obviously, on paper, it's a wonderful idea, but it's politically very difficult to do because obviously corporations, lobbyists, just like human beings generally, are loss averse, right? So you're always hard to take something and sort of give something. The people you're taking from have a much harder time giving that up than the people who benefit from. But you have sort of a built-in process every year where the corporate tax extenders, the R&D tax credit, the Subpart F, right, active financing deferral for financial institutions, two very powerful corporate groups, each year try to get their tax expenditures renewed. And so they face loss, right? So they're determined to get those things extended. So there's an opportunity there for the panel to recommend as a process matter that those extensions each year be paid for with corporate loophole closers. Just that process point, if that came from the administration, which you sort of get soundings of that from the House of Representatives, if that came from the administration, you'd have several years where you could lock in some good loophole closing, some sort of base broadening provisions, just because you have sort of political momentum behind very popular provisions. So we recommend you take a look at that.
And obviously consistent with a pay-as-you-go regime and fiscal responsibility. The final area we wanted to cover and spend a little time on, a long-standing area of Center on Budget and Policy Priorities work and expertise, the tax credits at the low end of the income spectrum, particularly the earned income credit and the child tax credit. As you know, these credits lift millions of families and children out of poverty. They also provide important work incentives. There's a significant research literature suggesting that particularly among single parents, the earned income credit has led to significant increases in employment and reductions in welfare receipt. Low-income credits also play another important role. In the '86 Tax Reform Act, they played a critical role in helping to ensure that the overall distribution of the reform was equitable. In '90 and '93, they were used for similar purposes to offset the regressive effects of increases in payroll taxes and gasoline, alcohol, and tobacco excise taxes. So they can be important instruments in a number of ways in a tax reform process. We recommend the panel think about reforms related to refundable credits in two contexts: incremental steps and broader reform. In the incremental steps, I think there are three key areas. One, which the President has proposed, is to make permanent the child tax credit and earned income tax credit expansions in the Recovery Act. The second is to improve the earned income credit for childless workers. And the third is to enact a series of EITC simplification proposals that the Bush Treasury Department proposed. They were greeted as good simplifications on the Hill. They were never a political priority. They were never acted upon, but they really ought to be. Taking each of these individually, the improvements in the earned income and child tax credits in the Recovery Act enacted in February of this year have a really large anti-poverty effect, particularly among children in working poor families. They also reduce marriage penalties in the earned income credit, and they improve work incentives. For example, welfare payments rise with family size, but wages don't. The EITC addresses this to a modest degree, but it only has two tiers: families with one child, families with two child. The Recovery Act added a third tier for families with 3 or more children, which both improves the work incentives and reduces poverty. We commend the President's proposal to make those expansions permanent next year, and we would note that if they expired, nearly 1.5 million people, including 800,000 children who were being lifted out of poverty by these expansions, would fall back below the poverty line. we'd like to talk for a moment about low-income workers without children. The earned income credit they get is extremely small. The president actually in his campaign proposed enlarging that credit. This is something many analysts from across the political spectrum have recommended, noting that the EITC has significantly improved employment and work incentives among single female parents, that we have low participation rates among a number of single adults, particularly including a number of minority males, and that a stronger earned income credit for workers without children could produce really beneficial results here. The Making Work Pay tax credit that is in the Recovery Act effectively serves that function. We operate on the assumption that it will expire at the end of 2010 due to its cost. If it does, we think it would be very important to then enact a regular permanent increase in the earned income credit for childless workers. We would note that the current credit rate is 7.65% of wages. Economists, as you know, really regard both the employer and employee shares as being paid by workers. We'd recommend increasing the credit rate to at least 15.3%. As you know, it's 34% for a family with one child, 40% for families with two children. We'd like to call your attention to slide 27. What slide 27 shows is that for low-income workers without children, the federal government is still taxing them significantly deeper into poverty. This is not true for families with children. The changes in the child and earned income credit have completely resolved that matter. But for workers without children, the tax burdens, when you include both income and payroll tax, continue to be quite substantial at very low wage levels, and an expanded EITC for childless workers can help address that. The final of the incremental proposals we strongly recommend are that you take a careful look at the EITC simplification proposals from President Bush's 2005 budget. Here, Treasury and IRS proposed to simplify the EITC abandoned spouse rule, to make a change in claiming children, and to eliminate the complicated earned income credit investment test. The last time I looked, the number of pages in the instruction booklet, the IRS instruction booklet for the EITC, was greater than the number of pages in the instruction booklet for the alternative minimum tax. The EITC is too complicated. Now, to be fair, most EITC claimants don't have to go through all of that. But we have all these extra pages and lines for some particular provisions in the EITC that affect small numbers of people but add considerable complexity. These three Bush Treasury proposals could significantly reduce the EITC error rate. Finally, on the broader reform front, as you know, there are options to consolidate what are now a large number of tax credits for low-income workers. The 2005 Bush tax panel had some very interesting proposals, a very interesting proposal to consolidate those credits into two credits, a family credit and a work credit. In a paper two of our colleagues at the center did in 2006, they have some very good analysis of this we'd recommend you look at. What we'd particularly recommend you look at is a paper that Jason Furman, when he was at the Center on Budget, did in 2006. What Jason did was he looked at the work and family credit proposals that the Bush tax reform panel put forward. He noted the fact that they were integrally embedded in some of the larger reform proposals that panel was making, which might be more sweeping than policymakers would want to do. So he showed how you could take their proposals in this area and with some tweaks and modifications, make them work on their own as simplifications, even if you didn't do all the other broader, more sweeping changes for the tax code as a whole that the Bush panel did. And he outlined that in a 2006 paper. If you don't have it, these are on our website, and we can easily get them to you. And the final point on the EITC is just that there are now 24 states with state-earned income credits. They're an important part of state tax codes. They generally exist. They're very simple. You get your state-earned income credit is, say, 10% of your federal credit. We make the point here simply because if one consolidates things so the federal earned income credit doesn't quite remain in its current form, one wants to take account of trying to make sure there's still something that's a simple hook for those states that want to piggyback on. The final point was just one. I'm sorry, Austin had to step out. Austin has done very important work on return-free filing. And the last slide, I want to be clear, is in no way intended to suggest that isn't a very important reform to look at. It's simply a caution that under the EITC as it now stands, particularly with its complicated rules for what constitutes a qualifying child, rules that are the main source of error in the EITC, that one wants to be very careful in moving to a return-free filing regime with regard to people getting the EITC. You want to be very careful that it not increase the earned income credit error rates or lead to a reduction in take-up rates by people who aren't otherwise required to file a tax return. I do think in Austin's paper of several years ago, he has several waves. This would really need to be a wave, I think, several years down the pike, and one would want to very carefully make sure one had addressed those two key issues before bringing EITC people. And obviously, to the degree that one had simplified the credit in the interim, that would facilitate moving in this direction. Chuck, anything you want to add?
Yeah, but just quickly back on the potential consolidation of the family credits and work credits into one, is just keep in mind those childless workers, that it's important to keep, if you had just one credit, there's a potential that those people could get left out. That's really a virtue of having a family credit and a worker credit. As you get into that very important population, can get included.
Great, thank you very much. We're
Great.
Vice Governor, we know you are as well. We greatly appreciate your input, and we'll take all this under consideration and look to some of the other documents that you referred to as well.
Thank you.
Thank you.
Introduce yourself.
I'm Joe Bankman from Stanford Law School. Okay, shall I jump in?
Absolutely. Yes, please.
Okay, and do we have anyone on the phone?
Keep going.
Okay, maybe we do, maybe we don't. Well, I'm going to talk about tax filing, and I've got a presentation, but my purpose is to be responsive to you all. So if you have questions, please interrupt me, and you tell me to go faster or go back or whatever you wish. Filing is outrageously expensive, even for wage earners. Best guess is wage earners spend $30 billion a year filing in time and money. That estimate can't, however, cover the hard-to-monetize costs of aggravation and anxiety. I'm going to talk about two ways to limit the cost. The first is a pro forma return, an estimated tax return. You might have heard about it with Austin Goolsby's simple return, part of the Obama campaign. We have that in California. It's called the Ready Return. So I'm going to talk about it in context of the California program that's operational, but I can talk about it more broadly as well. And of course, my emphasis will be how it could apply to the federal government. Then I'm going to talk about something similar called data retrieval. So to start with, I want to talk about the Ready Return program a little bit. And what I've done, sometimes it's easier when things are talked about if you can see an example. So at the end of this slide presentation, I think it's slide 19, if you go to page 19, you get some screen captures. This is an online program. So what I've done is I've shown you what it looks like if you're a taxpayer and you want to find your Ready Return. So you go online and you type in your name and your social security number, and if you qualify, it'll tell you. You qualify if you have wage income only. If you've qualified, it'll tell you if it's ready. Whether it's ready depends on whether the wage status hit the state. It takes a few days for the state to process it as well. If it isn't ready, you can leave an email, and the state will tell you when it is ready. If it is ready, and here we're maybe on slide 22 or something, you type in your password, and up comes your return. That's slide 23. It comes up first in a tabular form, and then in slide 24 in the kind of form that you're used to. It looks like a tax return. Then if you review it, you make any changes. Now, you don't have to ever log on and look at it. If you look at it, you never have to file it. If it's not right, you can make changes. You can download it and take it to your preparer to see if they can do better. If you're done, you can get your refund, direct deposit. It's 2 business days. It'll be in your bank account. Most people in this situation are going to have refunds coming, and then you're done with the process. I'm now going to talk about the pilot program that evaluated the process. The question is, how do we know if it's good or not? In 2004 and 5, if you're following me, I'm now at, back up to slide 5, although if you lose me, probably nothing hinges from that. In 2004 and 5, we had a pilot program. We gave 100,000 taxpayers ready returns. Despite obvious beta flaws in the program, which have since been corrected, an overwhelming majority wanted to use it again, 99% of the online filers. The average user saved $40 in 30 minutes. What's most significant to me are the taxpayer comments, and I have some comments in the slide program, and I think I have some others maybe at the end of this. And what I've done is I've given all the comments from the first survey, and there are 3 surveys. And the thing to do is just pick a page at random. You've really never read comments like this in your life. You know, I'm looking at one, wonderful, wish the feds could make it this easy. Great program, makes my life easier. You know, we're always wondering what taxpayers really want, and here they're telling us one thing they want in their own words. It's available to about 5% of Californians today. About 700,000 taxpayers. There was no statewide publicity, really, so it started off with a very low user rate, but those who used it stick with it and tell friends. Participation increased 500%, more than that last year. It's now about 10%. It's undoubtedly going to increase significantly in the future. It costs the state about $100,000 a year to run. There's cost savings associated with getting this program. There's fewer errors. People migrate to e-filing. So on the whole, it's probably a very small revenue raiser for the state. As good as it is, I think Ready Return is going to occupy a kind of bottom tier of solution to the problem of tax filings. The real monetized cost is at the opposite end, not surprising because those returns are more complicated. I sometimes like to imagine some taxpayer, I name her Leslie. She's a typical taxpayer who earns $1 million a year in wages, and the IRS publishes statistics on the Leslies of the world. And you can look at the items of income and deduction Leslies have, and there are a lot of them. They can have all sorts of taxable income, tax-exempt income, and the like. But the surprising thing is almost everything that typical Leslie has to put in her tax return is already subject to third-party reporting. So if Leslie could download all those 1099s and 1098s and W-2s, and we parenthetically maybe improve basis reporting a little bit for Schedule D, it turns out Leslie wouldn't have to do much to calculate her taxes. What we've done is we've substantially reduced record keeping, which is the single largest component of that $30 billion a year social waste in filing. We've also made Leslie's life easier and made her preparer's life easier. I'm assuming that someone like Leslie is still going to use a preparer. Almost all of America these days uses preparers. And what Leslie will do is have her preparer or her e-filing program download this. So everything I'm talking about would be platform neutral. So if you use H&R Block, that's where you'll get the data. By the way, I should mention that enrolled agents and CPAs who do the nation's tax preparation are on the whole wildly enthusiastic about getting access to these things because they don't like their taxpayers, their clients getting furious because they get an audit notice because they've lost a 1099. Now, we're not going to have all of Leslie's data, particularly in the early years. We can talk a minute more in a minute about how much data we can get and what we'd have to do to get it. But with data retrieval, you're not giving Leslie a bottom line, so you don't need all the data. You give her what you have. And there's a National Tax Journal article, which, God forbid, I don't actually suggest you have to read. But it talks about how we could integrate a data retrieval system with a system that changes the way we do amended returns and extensions. You know, a lot of Americans amend returns and file extensions only because they have one little piece of late arriving data. And it's really wasteful to take that data, go to your accountant, have her file an amended return. The government could ping the accountant saying we've got the data, and the taxpayer could have the option maybe of carrying that over to the next year with a slight interest charge. It would really, again, reduce social welfare costs and aggravation. Data retrieval doesn't do as much for low-income taxpayers as ready return, but it does a lot because it gives them their data. To some extent, it's better for those taxpayers than it is for Leslie because they don't have to add data because they're not itemizing. It does something else for low-income taxpayers that I want to emphasize, is it makes filing a one-stop process. If you see an H&R Block or Prepare, you can go right there and offload the chore instead of going back home and getting your data. That's significant because a lot of Americans don't file, and they're not tax protesters. Most non-filers have refunds coming. In California, we have over 1 million taxpayers who have refunds coming in and don't file. They don't file because they're bewildered by the process. If we could have the one-stop filing, it would allow places like an H&R Block to get these people into the system. I have a last slide here on data retrieval. I'm going to call it the last slide on this, and I'm going to talk about details, how you'd implement it. I call it transparency, but you might call it taxpayer rights, although that's an overused and kind of a loaded phrase. I mean, the government's collecting all this data on Americans. The least it can do is tell Americans what data it's collected in their names. Austin Goolsbee wrote an editorial once, and he says, why does the IRS ask people for information it at least theoretically has? Well, this is a theme here. I mean, think of a credit card statement. Visa doesn't send you a blank piece of paper each month and say, write down all your transactions and do the math, and if you're wrong, there's interest and penalties. They start the ball rolling by telling you what's in the government's computer, and that's what we should do for the 140 million American taxpayers. I have a slide here on implementation issues. It's slide 16. I'm just going to go through those. But again, I want to be responsive to questions you all have at the end of this or at any time. Right now, would data retrieval work or ready return? No. The federal government doesn't have the data. It would need to implement the programs. The reason it doesn't is we've got regulatory requirements on transmission of data that are out of date. So banks and employers mail employees' data at the start of January. They don't send that identical data to the federal government till the end of February, the end of March. Those are the due dates. Well, if those are the due dates, then the IRS isn't going to have the data in time for most taxpayers. The reason California can implement a ready return is that California, like many other states, requires quarterly submission of wage data. So by the end of December, or first week of January, they're going to get almost all the wage data, and they can have cleaned it up if it needs to be cleaned. So to implement any of these proposals, we need one substantive law change. It's quite a minor one. It's contemporaneous submission of data. And I talk about that in the National Tax Journal article, and I also talk about some ways. I walk through exactly what it means for a large employer to send data. I mean, how burdensome is the process? Is there anything gained by this 6-week wait? The short answer is nothing's gained by the wait, and I go through some modifications of the process that would leave private industry actually better off rather than worse off. In any cases, the changes would be small, but that's an important stakeholder, and I wouldn't want them to oppose a program that could offer a lot of benefits to their employees because there's a one-time changeover in data transmission rules. Security is another issue. And it's actually a constellation of issues. You know, when we started off, we didn't really focus on this. The reason, we didn't focus on it is because right now the tax return data is really insecure because it goes through the mails. So you get your W-2 and 1099 through the mail. We sent tax returns through the mail that had that same information. That was a cost-benefit calculus, thinking the average citizen would really appreciate getting the paper return, even though it meant her wage data is now going through the mail twice instead of once. Well, since then I've talked to people, including people at the IRS, people like Dave Williams, who maybe some of you have talked with, who's head of electronic filing. I can see that kind of attitude to security, however you might think of it from a kind of an economistic standpoint, is not going to fly with the IRS, and maybe it shouldn't. They're always going to be paranoid about security leaks because it's a political firestorm. So the programs I now envision are online programs, which can be more secure, and they're programs that would have conservative best practices of industry. And those will always change, and I can talk about what those are, but the bottom line is that we can do it. It's going to add a little bit of cost to the program. It's going to slow down acceptance a little bit because the IRS is going to have to outreach mostly to preparers, but to some extent do-it-yourselfers about how to get on the kind of security apparatus in the first place. How to get your password is the bottom line there. I mentioned costs, and let me say a couple words about costs. That's not on the implementation issues, but of course it's obviously relevant. The Ready Return program is unbelievably cheap, I think, given what it does. We're talking about less than $1 a taxpayer, a little bit more than $1 a taxpayer now in gross costs, going down because it's really infinitely scalable. I'm prepared to believe that anything you do in Washington is going to be many times more expensive. But the fact of it is these programs are basically so cheap to implement compared to social benefit that the cost could increase 100-fold and it would still be a good deal once the program's getting scaled up, because the per taxpayer costs when you scale it up for a nation go down dramatically. There's another kind of cost involved that I'm going to mention, and that's cost of lost tax revenue. Right? It's not exactly a social cost. The money is there. It's not wasted building a computer system, but it's in the wrong hands. It should be paid to the government. So the fear here is that when people know what the government knows, they'll quit reporting certain forms of information. So they'll quit reporting moonlighting income, for example. Well, of course, the fact is they don't really report it very much now. It's about a 20% reportage rate on moonlighting income. So one way to interpret that is the only people that are reporting it at this point are people who are doing it because they think rightly it's the right thing to do. But maybe that's not true. Maybe some of those 20% now won't report it. We looked at that in California and thought that the numbers were going to be so small that we weren't going to change the program, and we did one follow-up. I say we, by the way. California did this. I've consulted with them, but this is their program, and I think it's a great achievement of some kind of unknown IT people and leadership people in a state tax agency. But there was a follow-up study which suggested the revenue loss was small. But if it can't be, it might be this commission is thinking the sine qua non of anything is that it raises revenue, or that we've got to address the tax gap no matter what. That's our priority. You could use either of these programs actually to reduce the tax gap, I believe. And it's not that hard. Imagine we use the kind of insights of behavioral economics, cognitive psychology, in terms of what's salient and how things are framed. Imagine you go online, you type in your wage data, and a screen pops up and it says, just thought you want to know. A lot of people, believe it or not, aren't reporting this moonlighting income. That's taxable, and if you don't report it, it's tax fraud, punishable by 1 to 5 years in prison. If you were willing to do that, obviously that is a judgment call, but if you are willing to do it, I don't think there's any question that the reporting rate on a lot of these things would go up, and I bet it would go up significantly. In fact, per dollar spent on compliance, this could well be the cheapest investment you'd ever made, because it would cost about $20 to add it to your program one time. A final implementation issue I'll mention is, I put here, is the IRS can't be stuck with an unfunded mandate. You know, one way to look at a program like this is the social payoff can be absolutely enormous. I know you guys are thinking of other tax reforms, and there's a lot of great ones out there, including the presentation you just heard about about a unified credit for the poor. Absolutely a great idea, as many others are. There's not too many that you could say are plausibly going to reduce social welfare costs by $1 billion, $5 billion, $10 billion. But there are almost none that actually are going to interface with 140 million Americans. And what this program does is it really changes the way those taxpayers are going to view the government a little bit. And that's unique about this. One problem we have is that the IRS is a beleaguered agency. It's got a lot on its plate. It's got to internalize the benefits, and it can't really internalize the costs in that way. And that's why any attempt to move this forward has got to really reassure the IRS that at the very least they don't get stuck with an unfunded mandate, and at best they get rewarded for inevitably pushing themselves to add something else to their plate because the social payoff is so great. You know, I've designed this so I end early so that I can take questions. I don't know if that's permissible.
But you didn't
yes.
touch much on your cost benefit analysis.
Yes.
Pages, so why don't you do that for us?
Okay. So if you look at what we spend on compliance, and of course on filing, this is just tax filing. The best figures come from studies folks at the IRS, starting with Eric Toder and now going to John Guyton, if I'm pronouncing his name correctly, have done. That's $100 billion a year for individuals. So you start with this $100 billion a year base, and those are based on various studies done and using different methodology. A lot of that is for small business, and what I've done is I've tried to go through those studies and throw out the small business category, because we can't do anything for the small business person. They've got a lot of transactions, and this program doesn't help them, but we're still left with about $30 billion, and when you go to those programs, you find the monetized costs are mostly in record keeping. That's the single largest cost people face, and they're mostly at the top end. So what does that mean? That means that for the ready return, simple return, you're really not dealing with the top end, you're dealing with the bottom end. So you can look at the typical costs that the ready return users experience, and you can multiply that out, or you could look at Austin Goolsby's numbers in the simple return and multiply that out, and that's where you get the $2 billion a year. Now, everything is just a guess, and when you think about doing this for the low-income folks, I really think you have to think we're doing it because this is driving them nuts as citizens.
Please press any key on your phone to remain in contact.
Okay, so that's where I get the $2 billion number. Now, the $20 billion number is dealing with really the bulk of compliance costs that Americans are filing. That's really dealing at the top end where the record-keeping costs increase a lot too. Now, all these figures are through a glass darkly, because I'm starting with a methodology, and by the way these studies were done is they either follow people around or have them keep diaries. Well, you know, they're kind of accurate and kind of inaccurate. But what we know is that the numbers are huge. Again, what I like to emphasize is it's not just about those numbers. It's about taxpayers and knowing that their government is citizen-friendly. I don't include, in these numbers, I don't have a lot about the actual costs of running the program because the costs are just so cheap. I mean, in California, if we had 2 million taxpayers instead of spending $100,000 a year, it might cost us $200,000. Now, we're probably not going to go up to 2 million because as you go up the ladder on ready return, where you're giving people a bottom line number, obviously the risk and the cost of errors is going to increase. And so, in my view, the ready return is almost necessarily limited to low-income people where you can live with the mistakes you might make, where the data retrieval is for everybody. Now, that's a political judgment, and other people have differing ideas, and I certainly wouldn't oppose a dramatic expansion of ready return, but in my mind, I think that's the kind of cost benefit we're going to make. But the cost of getting data back to the taxpayers or to their preparers in an online sense is virtually costless. So when I get the gross savings, I don't really subtract very much from that.
Great. Okay. Thank you very, very much. We're running low over time. So So, and we have a few other things to do. We really, really appreciate this.
Sure.
And we will continue to follow this, as you know, as you point out, Austin's got a real interest in it. So I think this will continue. So thank you very much.
Sure.
It's very helpful.